When we say the financial markets, we're talking about the marketplace, be it virtual or brick and mortar, where deals are made, where buyers and sellers are exchanging financial securities. By financial securities, we're talking about things like stocks, bonds, and a couple other ones. We'll walk through those tonight. All right. So we'll talk about the role of financial markets, talk about some of the key players. We'll talk about some of the laws that govern them. We'll talk about the major types of securities, talk about primary versus secondary markets, and a little bit about investment strategies. We'll talk about it more when we do the next chapter in a few minutes. So we're doing 2 chapters tonight. And we'll also talk a little bit about stock quotes at the end of this chapter. All right, so I want you to understand that financial markets are essentially a way to transfer money from savers to borrowers. In your notes next to savers, I want you to put the word investors in parentheses, because I want to make sure that statement makes sense. That's the way the book puts it. But if you're thinking in terms of, wait, financial markets, aren't we talking about investing? Yes, we are. Okay, so the savers are the investors. Those are people like you and me, or, businesses make investments. So it could be a business. It could be an institutional investor like a mutual fund or a pension fund, right? All of those people can be investors. So they're wanting to put their money to work instead of just dumping their cash into a savings account at their bank and getting 1%, if that, in interest, right? I'm going to put it to work and make some money, more money off of your money. So those are the investors, and then borrowers are the people who need the money. So it could be a business that is, a corporation, or it could even be a government entity. So we'll talk about how that works. What are they using this money for? Well, it's probably, the book says to meet payrolls. It's not going to be for payrolls. That's ridiculous. You would never sell shares of stock or sell bonds to meet payroll. You would do it to invest in new facilities or develop new product lines or to compete effectively in global markets. Municipalities, for example, they sell bonds quite often. Municipal bonds, for example, are like issued by city governments to fund things like building projects. Like that area close to downtown, there at Franklin and Mill K, where it's kind of developed where the food trucks are, and some really pretty green space and the bronze statues and all that. That was, and that is under continual development. That was funded by municipal bonds. So corporations and governments would be the borrowers in this case. All right, let's talk about some of the players, first of all. So depository institutions are one of the categories of players. We're talking about banks, credit unions, savings and loans. Now, the lines between these types of institutions has been blurred quite a bit over the last few decades. I think we all know what a commercial bank is, right? Credit unions are very similar. You can have a checking and savings account in a credit union. One of the major differences is that it's owned by its members and they're nonprofit. Savings and loans, similar to the other two, but most of the loans that they give issue are mostly mortgage loans. Okay, so very similar. And then we also have non-depository institutions that are participating in the financial markets. When we say institutional investors, remember, we're talking about institutions that pool large amounts of money and invest that. So like a mutual fund is a type of institutional investor. A pension fund is another. An insurance company is another. All of those types of institutions pool large amounts of funds from multiple members and invest that money for the purpose of making a profit. All right. Also know that you and me can't buy financial securities directly. We got to go through a broker to do it for us. Also, securities dealers, just know that those are the people who make a living buying and selling securities. So buy low, sell high. That's how they make their profit, right? And then investment banks specialize in doing initial public offerings. Remember when we talked about in the chapter about the different types of business entities? When we talked about corporations, we mentioned that when a company makes that transition from a company to a corporation, like a C Corp, and you want to issue shares of stock, it's a very expensive process and it's very complicated. There's a lot of paperwork, a lot of bureaucratic hoops to jump through. Well, institutional investment banks, they specialize in helping companies become corporations. So when you hear investment bank, automatically think initial public offerings. Initial public offering is when a company first issues shares of stock in their company. Okay. All right. So some basic laws. We're not going to spend a whole lot of time on this. These are definitely slides you want to print out, by the way, before the test. So the Federal Reserve Act of 1913, as you might guess, set up the Federal Reserve. Remember, the Federal Reserve is the bank for banks. The Federal Reserve is the bank for the United States government. It is not owned by the United States government. It is not a federal agency. It is a co-op that is owned by banks. And then another thing the Federal Reserve does, remember, it has a lot to do with regulating our economy, right? Remember when we talked in chapter 2, we talked about the fact that the Federal Reserve, or the Fed, can grow or shrink the money supply to help impact how quickly it grows, and they can slow it down, right? So that was established with that law. The Banking Act of 1933 established the Federal Deposit Insurance Corporation, or FDIC. So in case you forgot, remember the FDIC insures our bank deposits. Because remember, banks make their money by loaning out 90% of the deposits that they receive. They loan it out. That's how they make their money. Well, if that's true, imagine if it was like toilet paper right now. What if everybody was trying to get their deposits pulled out of the bank at the same time? Well, the bank would run out very quickly, and it would probably go under, and a lot of the depositors wouldn't get their money. So before the FDIC, there used to be a run on banks. People would get spooked because something, the economy would just start faltering, and people would freak out and run to the bank and pull out all of their money. Well, they do that, the banks quickly would run out of cash, and then some people wouldn't get their money. So Banking Act of 33 did that. Securities and Exchange, the Securities Act of 33 established the SEC. Remember that, you'll be good on that. Securities Act of 34 gave the SEC, established the SEC and gave it a lot of powers to try to regulate the securities industry and prevent a lot of the fraud. For example, prior to this act, did you know that companies could say anything they wanted about their stocks and the future profitability of the company with no proof? They could say anything. So, imagine if you're an investor, and way back then in say 1933, and a company is going public, it's issuing shares of stock, doing an IPO, right? And you're an investor, and the company is saying, check us out. Our company is poised to create time travel It's going to be awesome. We're also going to invent flying cars and, all kinds of crazy stuff. And it's all right. It's on our drawing board. Company's stock is going to go through the roof. Well, as an investor, you'd be like, hey, I want a piece of that. I'm willing to pay a whole lot of money for this stock. They could drive the stock price up by essentially lying, by saying anything they wanted. So finally, the Securities and Exchange Act of 34 was like, enough of that. All right. You have to tell the truth. You have to set realistic expectations for investors. Financial Services Modernization Act of 99 was huge. Did you know, some of you in this class do, did you know that there was a time prior to 1999, that is, that there was no direct deposit? We used to get a physical paycheck. Yeah.
Yep.
Some of you remember it, right? You had to go every payday, you had to physically drive to a bank, go into the lobby and fill out a deposit slip. And if you wanted any money back, you also had to fill out a withdrawal slip and then wait in line to deposit your check and get cash. The young people in the room, I know, you're like,
That's still happening.
It sucked. Okay, so the Modernization Act of 99, it paved the way. It created allowed direct deposit, ATMs, and paved the way for online banking. Okay, so really cool. Totally dig that. It did some other thing though. Remember that it also prohibited commercial banks from like selling insurance or acting as an investment bank. Remember, we had a lot around the late 90s, early 2000s, we had a lot of big corporate scandals. So Sarbanes-Oxley Act of 2002 was enacted to make sure that we prevent some of that by really making sure that we didn't have any unethical relationships, any conflicts of interest between corporations and the public accountants that were doing their external audits. Remember, corporations are required to do an external audit every year, and that external audit report is supposed to accomplish their financial statements and the notes to the financial statements that are all together called the annual report, which has to be given filed with the SEC every year and has to be given to shareholders. Well, it used to be that there's a lot of conflict of interest. Like some of these consultancies were in bed with the corporations, and so they weren't being fair and unbiased like they're supposed to be. So, you know what? Investors weren't getting a fair assessment of the validity of a company's financial condition. Dodd-Frank, of course, that came out of everything that happened after the financial crisis of 2008. Put the kibosh on some of the more risky things that non-depository institutions were able to do that help lead to the financial crisis. So put the kibosh on that. All right. These are the major types of securities. There are others, but here are some of the most basic types of securities. So let's talk about those very quickly. Common stock, obviously, it is the most common. If you get a test question that says, what is the most blank is the most basic or most common form of ownership in a corporation, it's not a trick question. It really is common stock, okay? All right, so if you buy, for every share of common stock that you own, you get one vote in the annual meeting of shareholders. And remember, at the annual meeting of shareholders, that's where shareholders get to vote on major corporate initiatives, major changes to corporate strategy. Each share, one vote, okay? You also get a right to dividends if, notice that I put in bold or capitalized letters, if the company declares dividends, as in they pay dividends, you get some of those dividends, right? As a common stockholder. The company does not have to pay dividends. They could retain earnings. Okay. All right. So capital gains. Capital gains means that, I mean, a lot of people investors really focus their investment strategies on capital gains, as in you buy a stock at $10 and you wait for that stock to go up in value, and then maybe you sell it at $15. Well, if you did that, you would make a capital gain of $5 per share. Does that make sense? Right? That's a capital gain. And by the way, you pay a capital gains tax every time you do that. Just keep that in mind. But that is a capital gain. So, you know that common stocks are very volatile. They go up and down quite a bit over the course of the year. So you have the ability to make quite a bit of money with common stock. The problem is, though, remember that risk-return relationship. Buying individual stocks is at the top, the most risky form of investment, but it's risky because it can also give you a really good return. So remember that risk-return relationship. You do have a preemptive right to purchase new shares that will keep you at the percentage ownership you were at before the company decides to offer additional shares of stock. So let's say that you own 5% of a company. 5% of the shares of a company. And then the company decides to sell additional shares. Well, if they do, you're no longer going to be a 5% owner, are you? Because the pie just got bigger, but your piece didn't. So preemptive right means that they have to offer you the ability to buy a number of those shares to get you to 5% of the new number of shares. That makes sense? So that would keep you at the same level you're at. And a lot of times they'll even offer you those shares at a discount. So pretty cool deal. And then if the company goes under, hey, they would sell off all the assets of the company, you know, the buildings, the computers, the machines, tools, equipment, vehicles, everything. And then they would divvy that up amongst the owners. Well, you know, as a common stockholder, you are one of the owners, so you would get a piece of it. All right, preferred stock is just another kind of stock. I will tell you that not all companies have preferred stock. And if the company only has one kind of stock, it's probably the common stock, okay? But preferred stock, it's kind of cool. For one thing, if the company goes under, you get paid first. If your dividends are usually not as high as that of common stock, but they're a little bit more predictable. You get a known amount of dividend and you get them at regular intervals. So while common stock might do this, you know, over the course of the year or years, preferred stock, it's gonna just kind of cruise along like this. So you're not gonna make as much money on a capital gain on preferred stock. You're probably not gonna get as much of a dividend, but it's steady and it's a little bit less risky, okay? Some preferred stock also has something called a cumulative feature. Cumulative feature means that if the company decides to retain earnings for a couple of years, you know, like they want to finance some new big corporate initiative. Well, if you have this cumulative feature, when the company decides to start paying dividends again, check this out. You would get back pay for all those quarters that you didn't get your preferred stock dividend. They would have to pay you those dividends in arrears before they could pay out any more dividends to common stockholders. So that's kind of cool. On the downside, you don't get to vote. And again, your dividends are going to be lower than that of common stock, but more stable. You're more likely to get them. And so look at the bottom of the screen right now. And remember that companies don't have to pay dividends to anybody. But of course, they want to keep, the board of directors wants to keep their positions. So they're going to, they better be representing your interests as a shareholder. You know, they can retain earnings some, but if the company's making money hand over fist over a period of time, most of the shareholders are going to start beating up the board of directors saying, hey, you tell that CEO, you make that CEO pay us some dividends or we're going to vote you out of office. Okay. All right. Then there are bonds. So bonds are essentially don't give you ownership in a corporation. Bonds are like you are, as an investor, you are loaning a company money. That's really what it is. It's an IOU issued by a corporation or the government, be it the federal government, in which case it would be a treasury bond, or a municipal government, like a local government that you know, is looking to pay for a bridge or fix up the roads or build a new school or whatever. All right, here's how bonds work. So let me explain how bonds work with an example, okay? Let's say that you have a 10-year, $10,000 bond. So you, as the investor, pay $10,000 for this 10-year, $10,000 bond. So you pay $10,000 and the corporation, let's say it's a corporation, they get the $10,000 and start spending it on whatever it is that they want to spend it on. Meanwhile, they're going to pay you interest called a coupon rate at regular intervals over the course of that 10 years. Why they don't just call it an interest rate, I don't know. But when it comes to bonds, instead of calling it an interest rate, they call it a coupon rate. Or just make sure you write in your notes, it means interest rate, okay? Now, here's the thing. From the date that that bond is issued, from the date of issue, meaning the first time they make this thing publicly available for sale, that is the start. And 10 years later, that is the maturity date, okay? So what happens is you pay $10,000 for it, also called the par value or face value, right? And then on the maturity date, you're gonna get your $10,000 back. So you made interest payment, you got interest paid to you every 6 months for 10 years. And then at the end of the 10 years, they gave you your $10,000 back. That's how bonds work, right? So that's kind of how they work. But here's a wrinkle. You as an investor don't have to keep it for the whole 10 years. You know what? 5 years in, you might decide, meh, I'm gonna sell it. I want to do something else with my money. You can sell it. Now, here's the thing though. You don't have to sell it. Are you gonna be able to sell that $10,000 bond at its face value after you've already collected half of the interest payments?
No.
Probably not. I mean, maybe, but probably not. All right. So that brings us to current yield. So let's go back to our example. Let's say that you bought and write this example down, by the way, because you're going to have a few of these. You're going to get at least one test question on this. All right. So let's say that you buy that 10-year bond at a face value of $10,000, meaning that's what you pay for it. You pay, if it's a newly issued bond, you pay the par value, which is $10,000. All right. And you get it at a coupon rate of 3.3%. That means you're going to earn $330 per year in interest for 10 years. And unlike stocks, they are legally required to pay you that interest. It's not a maybe, they have to, all right? So you get your $330 per year, but you know what? You can get, you want to do something else with it, maybe you want to sell it. Well, if you're looking at a bond that is not a new issue, like somebody else owned it and they're selling it, and you want to decide, I wonder if this is a good deal. I wonder if this is a good investment for me. So you could take a look at its current yield. Current yield is simply, you would take the $330, which is the dollar amount of the interest, right, of the annual interest. So in our little example, that would be $330 divided by whatever the current market rate is for that bond. Let's say that the market rate is 8,000, or let's say, yeah, 8,000. Where's my example here? $8,630. All right. Let's say that that's what it's going for. All right. Well, that, if you do that math, $8,640 is what I have in my example. So 330 divided by 8,640 equals 0.038. And then if you move the decimal, that's 3.8%. That's the yield. So you could say, okay, if I buy this bond, I am essentially going to make 3.8% in interest per year. Right? Oh, if you guys would turn off your microphones, mute your microphones rather, unless you have a question. We're getting some feedback for some reason. Okay. Somebody asking a question? Rosa, can you mute your microphone? I think we're getting feedback from yours. Oh, might have lost her. Okay, anyway. So understand, if you sell it before maturity, you know what? You're probably not going to get it at a premium. If you're looking to buy, you're probably going to get it at a discount, right? Because the other person has already gotten some of the interest payments. So you're probably not going to be willing to pay the full face value. In our example, $10,000. You're probably going to be looking to get it at a discount, like $8,640 in our example, right? But you know what? There's some weird market conditions where you might pay more than the face value, even if whoever is selling it already got some of the interest payments, because the financial markets could be really volatile and really risky. Like everything seems really risky. So by getting into a bond that's really long-term, it could be a safe place to park your money that is still earning more interest than you can get by just putting it in a treasury bond, a T-bill, or putting it in a savings account or something like that. So it could, you might be willing to pay a premium for it. All right, now convertible securities, I want you to understand that a convertible security is not really its own entity. It's not its own thing. What it is a feature that some bonds or preferred stock has. Here's how it works. Let's say that you own some preferred stock, and you're chugging along. You're not getting a whole lot of dividends, but hey, you're getting some dividends, and you're getting them at regular intervals, and that's cool. But then you notice that same company's common stock is like taking off like a rocket. Like they developed some awesome new product and it's selling like crazy, and their common stock just started shooting up like a rocket. Well, your preferred stock might go up a little, but not very much. So you can exercise your convertible feature and trade your preferred shares for so many shares of that company's common stock so that you could get in on that big capital gain that you could get. Does that make sense? And by the way, it's not going to be one for one. Like you might, let's say you own 100 shares of preferred stock in ABC company, and ABC company's common stock goes way up, and you want to exercise your convertible feature. You might, be able to trade your 100 shares of preferred for 50 shares of common. It's not going to be one for one. Okay. But it's a cool feature. And you might ask, well, why the heck would companies offer it? Simple, to get you to buy it. It's a form of utility that some investors like because it's a cool feature. All right, so test question. If you get a test question that says, as an investor, Maria owns 100 shares of ABC company, 100 shares of ABC company's preferred stock. And she notices that ABC company's common stock is skyrocketing. What is she likely to do? The answer would be, she would, and it would say that she has the convertible feature. Then you would say she would exercise the convertible feature and trade her shares of preferred stock for the common stock. All right, now let me give you another question you might get. Let's say, similar scenario, Maria owns 100 shares of preferred shares of ABC company's preferred stock. She notices that the company's common stock is taking a nosedive, like something bad happened. Company sales are tanking. What should she do? The answer, nothing. Keep on getting your preferred stock dividends at regular intervals and hold what you got. Make sense? I know this is like drinking from a fire hose. I know it's a lot of information, but all right. So stop me if you need me to. All right. Let's talk about mutual funds. Mutual funds, pretty cool. I really, really, really like mutual funds. Mutual funds is a way to invest where essentially you are buying into a pool of funds that is really diversified for a very cheap price. Here's what I mean by that. Diversification means you buy stocks, different kinds of financial securities in several different sectors, financial sectors of the economy, right? Like maybe you buy some stocks in technology stocks. Maybe you buy some preferred stock in commodities. Maybe, you buy some wheat over here and some oil over here and gold over here and invest in all these different types of securities. That's what being diversified means. The idea is that if you have losses over here, hopefully it'll be made up for with gains over here and here and here. Make sense? That's what diversification means. So if you or I were trying to build a very diversified portfolio, it'd be really expensive because you got to buy a lot of stuff, right? So what's cool about a mutual fund is it's a company, essentially, right? Well, a company may have various funds. It is a product. They pool a bunch of people's money, like you and me, and they diversify, they get investments in all these different things, build a diversified portfolio, and then you and I can buy a share of that diversified portfolio. Make sense? So it's a cool way for you and me to buy into a very diversified portfolio that would cost a ton of money to do it on our own. Another cool thing is each one of every piece of that mutual fund is managed by somebody who does nothing but follow that particular industry or that type of investment all day, every day, as you know, and studies it. They analyze it. They're looking for trends, and they manage that piece of the fund. So one mutual fund may have a bunch of managers who are managing different areas of that fund to make sure that the whole fund is profitable and makes money. Now, how do you know if a company's or if a mutual fund is being managed well? Look at the history of it. How much interest rate is it been returning to its shareholders every year over time, right? So you could do a Google search on it, on the name of the fund. It could be called the Pacific Growth Fund. It could be called the Tech Stock 500 Fund. It could be called the Superman Fund. They can call it anything they want, right? But what you can see when you look it up, and you can look it up on your favorite financial website, like a trading website, if you have an Ameritrade account or whatever, you can go there and look it up. You can look it up on Yahoo Finance, whatever you like. But you can see a history of how well that fund has performed over time, and see if it's at a good level or not. I mean, is it making 8% pretty steadily? 8, 9, 10, 11, 12% interest? Now we're getting pretty good, right? If the fund is returning like 12, 13, 14%, holy crap, yeah, buy into that fund. That's a good return. All right, it's easy to get your money out, but you get your money out of a fund in one of two ways, depending on whether it is an open or a closed fund, okay? Open versus closed fund. So a closed-end fund issues, write this in your notes, please, trust me. Closed-end fund has a fixed number of shares, and you can trade those shares just like stock. So if you want your money out of that mutual fund, you just sell it right on the, click on your investment account and click on that mutual fund and how many shares of it you want to sell, and click sell. Done. Get your money. Whatever the market rate is for those shares at that moment, that's how much money you get. All right. So that's a closed end. An open-ended fund does not have a fixed number of shares, but you cannot trade those shares like stock. In other words, if you want your money out, you sell it back to the fund itself at whatever its going rate is for selling those shares. Okay, so make sure you know the difference there. And just as a summary of what we talked about, mutual fund advantages, you can get into a diversified portfolio. And by the way, when we say portfolio, we just mean all of your shares, all of your financial investments. Cumulatively, you would call all of your different financial investments a portfolio. So you could have a share of a very diversified portfolio at a really inexpensive price. It's managed by people that know what they're doing. It's easy to get your money out. It can be open or closed. Make sure you know how to get your, what open versus closed means. On the downside, yes, you got to pay a management fee. These aren't big downsizes. Management fees are not that much. You're probably going to make quite a bit more than the 1 to 3%. There are some tax implications because remember, every time you or I make a trade, in other words, buy or sell stock, if we make a profit, right? Well, you don't, not when you buy, but if you sell a share of stock, and make a profit, that's called a capital gain, and there's a capital gains tax. Well, guess what? Mutual funds are no different. So every time the fund manager or managers make a trade as managing that fund, if they make a profit, you as a shareholder are going to pay a little bitty tax. Now, as a fractional owner of a gazillion-dollar fund, it's not going to be much, but yeah, there's some tax implications. You know, if they make a whole bunch of trades, it might eat into your profits a little bit, the amount of interest that you make. And then lastly, some of them aren't as diversified as you might think. But you know what? Personally, I don't care. If this mutual fund is making me money, hey, I'm good. I don't care. But just know that. All right. Some other weird types of investments you may not have heard of. ETFs are another. So they are kind of like mutual funds, but they're made up of a market basket of a lot of different kinds of securities that typically reflect some sort of stock index. So instead of having, you know, all kinds of different investments like a mutual fund, this is more like a standard set of stocks that match an index of some kind, like a technology index or a Fortune 500, like the NASDAQ index or the S&P 500 index or something like that. All right. They're traded just like stocks though. So you can get your money out anytime you want by just selling them. Let's talk about primary versus secondary markets. Now this can be confusing, so pay close attention here. All right. So a primary market is where shares that have never been sold before are sold. Write that. I would use those words. Primary securities markets are where securities that have never been sold before are brand new. That's where they are sold. That is a primary market. All right. So it doesn't mean that when companies issue stock, do an IPO and they're sharing. So obviously if they're doing an IPO, initial public offering, those are new shares. So they would definitely be sold here, right? But what if 10 years later, that same company was like, we're going to issue some additional new shares of stock? Where would they be sold? Still here, because this is where brand new, newly issued shares are sold. This is in the primary markets. Clear? All right. Now, they can do this in two different ways. They can do a public offering where these shares are available to you and me, you know, as average Joe investors, but here's the problem with that, and write this in your notes. It's a test question, I remember. The problem with that is that you got to the company has to file a bunch of SEC paperwork and pay a bunch of fees, and it's really complicated and expensive. All right, now it would be worth it if they were selling a whole bunch of shares, because they would get economies of scale, meaning the cost and the pain and the butt involved would be worth it because they're selling so many shares, and they're probably going to get a better price doing a public offering. They're probably going to get more money for each of those shares than doing a private placement. So it may be worth it if they're issuing a lot of shares. Now, a lot of companies, though, they just do private placements. They're like, no, it's too expensive and too much of a pain in the butt. We're not big enough, or this isn't a big enough offering in order to go through all that pain and expense. So we're just going to do a private placement. That's where they get to skip all the SEC paperwork, most of the SEC paperwork and most of the expense, and just sell to people we know or to institutional investors that we know, like to a mutual fund, your buddy that manages a mutual fund, or your pal that manages an insurance the investments for an insurance company or to some wealthy individual investors that you know. And then you just, that way, you're just negotiating the price of each share between them. It's between you and them. Make sense? So it's kind of the difference. All right. So IPOs, initial public offerings, is that first time you sell shares of stock. The company, that's the first time a company ever issues any shares of stock. That's why they call it initial public offering. All right. And by the way, what kind of an institution does IPOs? What kind of bank? Anyone? Nobody.
Investment bank.
Thank you, an investment bank. Good job. So investment bank, exactly. Now the investment bank will do this one of two ways. We'll say best efforts approach simply means, hey, we're going to do the best we can to get you as much money as we can. We're going to do some, talk you up, do some marketing. But hey, there's no guarantee that you're going to make as much money as you hoped you would. The firm commitment arrangement, on the other hand, is when the investment bank actually buys it themselves. In other words, they call that underwriting the IPO. That means the investment bank itself is buying all of the shares and then trying to resell them to make their profit. Now, you know, risk return, right? It's riskier to go best efforts approach. It's riskier because you don't know if you're going to make as much, but you have the possibility of making a lot more per share. If you go firm commitment arrangement, well, there's less risk, but you know what? Those investment bankers are not dummies. They're going to make a profit. So you're probably not going to make as much as you might be able to if you had used the best efforts approach. So, all right, secondary offering. Again, if it is the first time a company sells stock ever, that's an IPO. If 10 years later, they're like, we're gonna sell some additional new shares, brand new shares, then that is called a secondary offering. Okay, all right, now that's primary markets. Again, primary markets are where newly issued, brand spanking new shares are sold. Secondary markets are where you and I buy. That's where the people who bought it in the primary securities markets have held it for a while and then they sell it. When they sell it and then you and me buy and sell it, trade it with each other, you know, on the stock market, on the stock exchange, that is considered a secondary securities market. Okay, so the New York Stock Exchange is a secondary securities market. The Dallas Stock Exchange, the London Stock Exchange, the Tokyo Stock Exchange, the Chicago Stock Exchange, all those different exchanges are secondary exchanges, right? A couple other kinds of places you might not have heard about where you can also buy shares. One is OTC, over-the-counter market. Now, those are typically much smaller companies, much less expensive, and it is much less expensive for the companies to post their shares on the OTC. But essentially, an OTC cuts out the middleman, it cuts out the exchange, and it puts buyers and sellers together, and they negotiate it between themselves. Now, here's the problem, though, with the OTC markets. I caution any of you from jumping into the OTC markets if you don't know what you're doing, because you don't know what a good price is for any of the assets that you buy. You know, on the regular stock exchanges, you know what people are paying because it's whatever the market price is. And the market price goes along that little ticker at the bottom of the screen. So it's updated by the second at what people are paying for it. So you know what the market price is all the time. The OTC market doesn't do that. It doesn't make the buy and sell prices levels public. So you might go in thinking that $15 a share is a great screaming deal on some little company's stock. And then maybe you find out later that, oh, everybody else is buying it at $5 a share. Crap, what have I done? Right? So it's a way. It's another place that you can buy securities, but I don't know, get some advice, do some research before you jump into that. And then there's also ECNs. ECNs are considered an alternative trading system, or ATS, right? Put in your notes. It's similar to an OTC. It matches buyers and sellers together, but instead of like the OTC markets where you would negotiate prices like on the phone or via email or through some back and forth, electronic back and forth on their website. In an ECN, you would get on there and say, hey, I'm looking to buy this security at this price. And as soon as somebody else on the other side says, I'm looking to sell this, I'm willing to sell at this price, and that matches yours, then the deal is done. Another cool thing about ECNs is that you can do trades 24 hours a day, 365 days a year. So in your notes under this ECN one, put after hours trading. After hours trading. I guarantee you, if you get the test question on ECNs with that little hint, you'll get the right answer. All right, let's talk a little bit about personal investing. We're mostly going to cover this in the next chapter, but very, very quickly, you know, you and I can't buy securities directly. We got to go through some sort of intermediary, like a broker, full service broker or a discount broker. Now, obviously, a full service broker is going to charge you fees, a lot more fees for every trade they make. Whether you make money or not, they're charging you a fee and they're going to make money. But of course, they want you to make money or you're going to use somebody else. But a full service broker is someone that you can call on the phone and they're going to know you and you have an account with them and they're going to give you advice. They'll know what kind of securities that you are interested in. They'll know what your some of your short-term and long-term financial goals are, what your risk tolerance is, you know, because when you get set up with an investment house and set up your account, you give them a ton of financial information and you answer a ton of questions about all this stuff, right? So then you are assigned a particular broker within that firm, and that's somebody you can call anytime and ask questions, ask advice, and based on your preferences, they may call you up someday and say, hey, I've got this great stock that I think is really going to take off from what I've read and heard. I recommend that you buy some. And you might go, okay, well, what's it going for? Blah, blah, blah. Okay, well, you know, buy me 200 shares. Okay, done. Talk to you later. Click, right? That's a full service broker. A discount broker, that's like the app that's on your phone. That is a discount broker. Your favorite trading website where you can do research on stocks and get a lot of information, but it's all you. That is a discount broker. Okay, most discount brokers are all websites and apps these days, but that's a discount broker. And then there's robo-advisors. Robo-advisors are kind of cool. They're relatively new. In fact, I think I still have one pulled up. Yeah, I do. Robo-advisor, there's two that your book mentions, Wealthfront and Betterment. These are kind of cool. You go in and it's kind of a merger of the full service broker and the discount broker, but it's all automated. It's kind of weird. You go in and you set up an account and you answer a whole bunch of questions about, you know, how much money you make, what your bills are every month. So therefore, how much money you have to invest each month, roughly. It asks you any short-term financial goals, like I want to buy a new car in 2 years. I want to buy a new house in 5 years. I want to retire when I'm 65. All that stuff, right? You answer all these questions, and based on how you answer all those questions and based on all your financial data, it automatically goes into your bank account every month at the end of the month, and it pulls out the money you're not using and it invests it based on how you answered all those questions. So obviously you can control it. It's not stealing money from you that you didn't want to be pulled out, but you set it up. The cool thing about it is it's based on algorithms that are supposed to make you a good amount of money. So it'll buy and sell different financial assets in a way that hopefully will make you a good amount of money. I've always wanted to try it, and let me know if you guys, if anyone's ever tried it or known somebody that's tried one. It sounds kind of cool. Betterment's the exact same thing. Set up an account, answer questions, and then it automatically pulls your money and invests it for you. Makes stock trades. And by the way, when I say trades, we're talking about buying or selling financial securities to make money. That's what making a trade means. All right, so let's finish up this chapter so we can get into the second one, get that done. Second chapter won't take as much time because it's a lot of the same information, by the way. All right, so what are your considerations when you're thinking about investing? Well, like I said a second ago, what are your short and long-term financial goals? Given your budget, how much can you invest? Of course, that's a loaded question, right? Because you can make more money available to invest if you are disciplined. You're not going out to eat as much. You're not buying as many toys, right? You're trying to be good, stick to a budget. Well, if you do that, you can cut certain things out of your budget so that you will have more money available to invest. Talk more about that in a second. How long can you leave it invested? How worried are you about tax implications, and what's your risk tolerance? Meaning, how okay with you are you with risk? Are you one of those people that like freak out every time your money you lose a little bit of money because there's a temporary dip in the economy or in the assets of the company that you're invested in? Or are you one of those people that's like, nah, let's go for broke. I want to be up here on the risk returns scale. I'm okay with risking my money, and I am comfortable with big fluctuations. I'm losing money. I'm making money. I'm losing money. I'm making money, right? Because you're in it for the long term. Depends on you. I will tell you that a lot of that should depend also on how old you are. Talk about more on that in the next chapter. Sorry, let me minimize this stupid thing that keeps popping up. All right, so let's say that you are investing. A market, there's two different ways to buy or sell securities. One is a market order. That just means that you're telling your broker to buy or sell at the best price that's currently available, right? So if you're telling your broker to buy, you might say, hey, whatever Microsoft is at right now, buy me 10 shares. So whatever it's selling for at that second, they click the button, that's a market order, whatever is the best price you can get. A limit order is a little different and kind of cool. A limit order is when you say, hey, I think Microsoft is gonna go up over the next few weeks. So I'm looking to buy Microsoft, but I don't want to pay a whole lot for it. So if it goes down to this price, buy 100 shares, right? If you're using if statements, or you could say, hey, I own I own Microsoft stock, and man, it's really volatile. It seems like it's heading down. Well, I paid whatever $100 for per share, and it was like 120, and now it's just keeps going down. If it gets to 105, just sell it. That way I make at least $5 per share. I don't lose money, right? But you use that if statement. If it gets down to this, then buy it. If it goes up to this, sell it. Make sense? Okay. So there's different ways, different reasons to invest in securities. One is investing for income. Like you're not looking to make a whole lot of money anymore. You're just looking for a steady stream of income. So people that are moving into retirement, they would be investing for income. So they might move their money out of stocks and out of most mutual funds and put it into preferred stock and bonds, because they're going to get that even pretty low risk, very, very low risk. Not a whole lot of interest, but it's better than taking all of their money out and putting it under their mattress or putting it into a savings account. So investing for income is one way to go. Market timing just means that you're trying to time the market so that you can make the most money. For example, if you're looking at a stock and you notice you look at what it is sold, how much it has sold for over the last year, say, and maybe you're starting to notice a pattern when you go back. Over the last year, it looks like the stock price went up around the holidays, and then it dipped down for a while, then it went up for a while, then it went way down in the summer, and then it went back up during the holidays. Well, then you might look at the 5-year history of it. And if that same pattern seems to be repeating, when would you want to buy it? You would wait until summer when it was at its lowest, or you thought it was at its lowest. That's when you'd buy it, right? And then you'd hold it for a while. Let's say 5 years from now, you're looking to sell it. What time of year would you want to sell it? Obviously, when it's normally the highest, right? So you'd wait for the holiday season and try to guess that I think this is about as high as it's going to go. Sell it. And then you make a capital gain, right? You can also do, like, day traders, they use market timing, but they do it by the hour. Like, they might buy a stock at $10 in the morning when the market opens and sell it at lunchtime. And they use software that helps them kind of figure out the timing of when stuff goes up and down. So market timing, investing for growth, that's when you're looking for companies that are expected to really take off from your regular business reading, right? From watching the news, multiple different channels, from all the things that you read, the business periodicals, Fox Business, CNN Business, watching Bloomberg, or reading whatever your favorite news is, right? Let's say that you come across some company that seems like, wow, they've got some really innovative, cool new ideas, or some new product they're trying to develop, and you're like, man, I think these people got it together. I think they're going places. I wonder if they have any stock. If they're a publicly available, publicly traded company. So you could go out on your favorite financial website, type in the name of that company, hit search. Oh, yes, they do have stock available. Holy crap, it's only $5 a share right now. I think it's really going to take off in the next few years. I'm going to buy 300 shares of it and hold on to it, hoping that it does in fact really take off, because then the stock price will go up. And then instead of it being worth the $5 a share that you bought it for, maybe it's worth $50 a share. Then you can sell all those shares you bought and make a huge profit off of that spread, right? So that's investing for growth. Value investing, I put it on here because it's what the book mentions it, but that's stupid. Essentially, value investing says you're looking to buy low and sell high. Well, no, duh. So is everyone. So it's not really an investment strategy. That's stupid. It's like saying you're buying a car for transportation to get you places. Yeah, okay. I don't see a car commercial that would put that as a category. You know, obviously buying. And then buying and holding them. Any good financial advisor will tell you, for the most part, best thing to do is buy and hold. Don't, you know, buy into some mutual funds, participate in your company's 401k, which is going to invest mostly in mutual funds. And leave your money alone. Don't freak out every time the market goes down and sell and buy and sell and freak out and stress. Once a year, look into your accounts, do a little bit of management. You know, hey, do I need to, maybe I'm going to move things from this fund to this fund, but keep in the same risk category. I'm getting a little bit older now, so I'm going to start shifting some of my investment, the percentage of some of my investments into some of the lower risk categories of funds, right? But as a rule, buying and holding for a long period of time, because I want you to understand this. The more money you have, the faster it grows. And if you hold it for a long period of time, it grows fast and it grows big. So if you guys start investing right out of school when you're young, by the time you're 55, 60 years old, you'll be a millionaire. I got a good buddy that's a cop in Dallas. He is a multimillionaire, or he will be when he retires, which he's going to, I think, in a year now. And here's all he did to become a multimillionaire. When he graduated college at 22, he became a cop and started participating. He maxed out the max amount that he could participate in his agency's 503B, which is like a 401k, meaning that they took money out of his paycheck every month, and he signed up, elected to have them take out the maximum that you possibly could, which was like 6% or 7% of his income. And he also got an individual went to his local bank and bought an individual retirement account, and every month put the maximum allowed by law that you can put into an IRA. And he did that every year. And so now he's been a cop for like 35 years and is getting ready to retire. He's a multimillionaire. And you know, cops don't make that much money. So that's the time value. That's the magic of compounding, what it can do for you. Okay.
Is there another way to become like rich without having
well, sure. There's lots of ways. But that is probably the way that the average person can become a millionaire, is by doing the buy and hold strategy. And we'll talk more about investing in the very next chapter. All right, just a couple of quick things. I'm not gonna spend a lot of time on this. A stock index is simply a mathematical calculation that tracks the overall performance of some of the different financial sectors. For example, the Dow Jones Industrial Average, or the Dow. It tracks the prices of 30 large US corporations, And it's just a really quick snapshot of how well the financial market's doing. Like, if you go back and look at the historical average of the Dow a couple of decades ago, you know, if it was trading at 14, 15,000, that was considered pretty good. But, you know, as the economy has grown, it's higher. It's expected to be higher now, right? So just a few years ago, like 5 years ago, heck, when it got into like 22, 23, it was considered really, really good. It got as high as, I think 27,000 for a little while. And then the last 2 or 3 years, heck, you know, it's been close to 30,000. Well, it lost a lot, obviously, during the pandemic, but it's already starting to come back. So if you see that the Dow is starting to come back up and it's approaching 24,000 again, which is amazing, that's a good indication that investors think we're going to recover. We're going to come out of this, and we will, by the way. It's going to be rough for a while for businesses. A lot of businesses are going to go out of business. A lot of people are going to lose their jobs, but the estimates are that we will come back from this, right? So S&P 500 is another index to look at that can give you a good idea of how the financial markets are doing, and therefore how the economy is going or projected to go very soon. The NASDAQ is the third one that I would definitely want to know as general business knowledge. All these other ones, just read through those on your own and make sure that you know that they are there. But most people only know about the Dow as far as indexes go, like the Dow and the S&P 500, and some of the the NASDAQ. If you know those, pretty good basic business knowledge, but definitely print this slide out for the test so you can reference it. Now, very quickly, how you read a stock quote. You know, have you ever been watching the financial news and that little ticker is going across the bottom of the screen? Ever wonder what in the heck that is? What that is telling you is last trade, which is the current market price. If the markets are open, last trade is the same as the current market price. That's what that stock is going for right now. So like Google, if you see I think it's ALP go across, is that it? I think that's the abbreviation anyway. Stands for Alphabet. That's the name of their stock, of their big holding company is Alphabet. So you'll see ALP or whatever, and then you'll see a number. That is the current market price per share of common stock. And then next to that, you'll either see a green triangle pointing up. That means it's trending up. And since yesterday, its price has gone up, and it'll give you another dollar amount, which would be like $2.12, meaning, hey, since the close of the market yesterday, meaning today, that stock has gone up by $2.12. Does that make sense? The opposite would be if it's going down since yesterday, then it would have the abbreviation of the company, current stock price, or last trade. And then next to that, it would have a red triangle pointing down, and it would have minus $1.12 or whatever, how much ever it has dropped since the close of trading yesterday. Okay. Now, the markets are only open Monday through Friday, 9 a.m. to like 3 p.m. Okay. So when I say the last trade, it's the last time it was traded, the last day that the market was open. It's not open over the weekend. All right. Change is the price difference between the last trade from the closing price of the stock on the previous day. That is the change. So that's what is next to the triangle. when you watch the ticker go across. Okay. Bid and ask is the highest price currently offered to buy and the lowest price currently being offered to sell. Now, is that really useful for you and me that is looking to buy a stock? Probably not. I mean, what I would pay more attention to is the days range and the 52-week range. Because I want to know is how well has this stock performed over the last year? If it's doing this over the last 12 months, am I going to buy it? Of course not. Looks like I'd lose money if I bought it. Why would I? Right? But if it's like doing this, yeah, I might. If I think that it's in one of the valleys, you know, one of the valleys that seems lower than it normally is, then yeah, it might be a good buy because I could hold on to it for a while and eventually it seems like it's going to go back up and then I can sell it and make a profit off this spread. Even the days range though, let's say I decide to buy a stock, but it seems like it seems to be at the highest price during this time of the day. Well, if I decide I'm going to sell a stock that I own, and it seems like over the last 2 weeks that it always is at its highest of the day at 1 p.m. Well, man, I'm going to wait until 1 p.m. and sell it then. You'll make that extra little bit of dough. Volume is the number of shares of stock that are traded up to this point in the current trading session. When we say trading session, that means in today's trading. That's what that trading session means. A market cap just means the total market value of the shares of a particular stock. You've got 100 shares of a stock that's worth $10, then the market cap is 10 times 100 or 1,000. Makes sense? All right, PE ratio is the stock's price divided by earnings per share. So the higher the PE ratio means that you expect greater growth in earnings over time. So you'd be looking for PE at the PE ratio as a really quick, you know, it's a financial ratio. It might be a pretty quick way to gauge if something's a good buy or not. Earnings per share, kind of the same thing. You're taking net income divided by the number of shares of common stock. That can give you, you know, how much money can this make per share. And then dividend and yield. So yield is equal to the dividend per share divided by the previous day's stock price. And that'll help you know, is this stock maybe doing better than yesterday? Is there a trend starting right now or not? All right, so that is this chapter. Make sure you guys are flipping through your digital flashcards every day. You need to know these. It's good basic business knowledge, plus you need to know before you take the test, because you don't have time to look up all this stuff, okay? That's why I keep begging you guys, study, study, study for this test. This test is no joke. I would also read each chapter at least twice. The second time you read it, do that metacognitive technique where you read a paragraph, you stop, you say out loud to yourself, what did I just read in your own words? If you can't do that, read it again. Do that for every paragraph till you finish the whole. That will take you a few, couple hours, but it's worth it. All right, any questions on that chapter? All right, let's close out of that. And we're not going to spend a whole lot of time on this because, again, a lot of it is repeated. So that's why I put this chapter with the one we just covered. Where is it? It's Personal Finance Appendix. There it is. So this chapter just focuses on investing from a individual point of view. From an individual point of view. So the last chapter covered some investing, but it was really from a generalized point of view. And bear with me 1 second, I forgot to take out my notes for this chapter. Drink. All right. If you watch the video, and let's see if it will play. I don't know if it will or not. Let me know if you guys can hear this video. I don't, didn't even play. Let me know if you can actually hear anything. Can you guys hear anything right now?
I can.
You can hear music?
Yeah.
Can you hear them talking on the video?
A little bit, like you can barely hear it.
Stop me if you guys can't understand what they're saying.
Yeah, right now we can't understand what they're saying.
Yeah, I can't hear him anymore.
Okay. All right. So I won't play the video. I'll let you guys download the slides and then you can watch it yourself. But essentially that video is, they're asking a bunch of college students some really, 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 really simple, basic financial questions, personal financial literacy questions, like what does APR mean? And most of them cannot answer the question. And then they ask them, I can't remember what some of the other questions were, but anyway, they're really, really simple, really basic, obvious questions. Well, they should be simple, basic, obvious questions, and they don't know. But yet then they ask them questions about pop culture and they're just, every one of them are like, blah, blah, Lady Gaga, you know, Kim Kardashian, blah, blah, and you just rattle it off. The point is, you should be financially literate. So we're gonna try to fix that in the next half hour, all right? So definitely watch the video. It's worth a chuckle and it definitely makes you think at the very least. All right, so we're gonna talk about budgeting and personal finances tonight. We're gonna talk about how you build a sufficient savings. We'll talk about using credit wisely, and we'll talk about how to build wealth. Buy and hold is coming your way. All right, so just a kind of an interesting tidbit. I saw this financial literacy quiz. I went online and I took it. It just had 6 questions. And it was really simple questions. I'm happy to report I got 6 out of 6. Yay me. But I teach business for a living. So look at the results though for like the national average was like half. People got half of them right. Texas was even less than half. That's sad. Don't be one of those people. Okay. Really quickly, let me tell you a quick story about my friends Albert and Michelle. Albert and Michelle, 2 of our very, very best friends, they met when they were 19. They met in college when they were 19 years old. They got married a year later while they were still in college, going to Lubbock Christian University, which is a very dinky, tiny little school, but very expensive because it's a private school. But anyway, that's where they met. They got married at age 20 while they're both, you know, living on student loans and crappy part-time jobs like we all do during college, right? They lived in a teeny tiny, when I say teeny tiny, they lived in a 300 square foot garage apartment. Of course, their rent was super cheap, was really cheap. But it was a teeny tiny little bitty apartment. And by the way, Albert, my friend, Albert, is 6'8". He is a big dude. So anyway, when they graduated from college, he became a firefighter in Lubbock. They don't make much money. Michelle went on to get her master's degree and her PhD, just straight to her PhD, in art, and became a professor a few years after that, like 5 years later, at Lubbock Christian. Professors at Lubbock Christian do not make much money. So now we've got two people that don't make that much money. I mean, they make okay money, but a firefighter and a college professor at a really small school. But here's the thing. This is what Albert and Michelle did. Did they run out and get a really nice apartment and buy brand new cars and start spending money? No, they did not. Here's what Albert and Michelle did. They stayed in that crappy little apartment for 6 more years and continued to drive their piece of crap cars for 6 more years, while all their friends were buying new cars and new clothes and big screen TVs and all that. They weren't doing that. You know what they were doing? They paid off all of their student loans in those 6 years, and they saved up $20,000 in cash. They put $10,000 down on a house, and they bought $10,000 worth of furniture to furnish said house. They have stayed almost completely debt-free ever since. And by the way, at their modest salaries, they have invested every single month without fail that entire time since they graduated. You know what? They both retired last year, and you know what they do now? Whatever they want. Whatever they want. They're finally starting to spend some money. Like Albert now has this probably a $70,000 pickup truck. Michelle's car is still used, but it's decent. And they travel. They travel is the main way they spend their money. They'll go to like Italy and stay for 2 months, stuff like that. Yeah. And they didn't make that much money, but they didn't spend a lot of their money. They participated in the retirement plan at their work. They maxed it out, and they got individual retirement accounts, IRAs, every year, invested in those, and put back as much money as they could, put it to work. They live very conservatively, but you know what? They're not any less happy than anybody else. In fact, they're more happy because they never had the stress about money. Most Americans, when polled, poll after poll, when asked what is their number one stressor in their life, you know what the answer is always? Money. They worry about money. And if you think that it's only poor people that answered that, you would be wrong. It's people at every income level up to a very wealthy level. So even a lot of people making $300,000 a year still have money worries, because what happens to most of us? We're making this amount of money and we're stressed about money. We don't have enough money. And we say, oh, if I could just make more money, I'd have some breathing room. But then what happens? You start making more money, you get a promotion, you start making more money, but then what do? We spend more money, then we make more money, then we spend more money, and we're just chasing our tail our entire life. What if you could be responsible with your money, you could build wealth for your future, and never worry about money again? Like, never have to stress about money. That's what this chapter is about. Okay. All right. So let's talk about how to do that. Yeah, and those people, some of the questions were like, how do you calculate simple interest? I had no idea. So let's talk a little bit about budgeting. And I want you guys to watch the personal budget video that comes with your book, right? So one of the very first steps in getting control of your financial situation is to develop a budget. Okay, it's just a detailed forecast of your expected cash flows, just like a cash flow statement, right? You know how much money is going to come into your accounts next month from your job or your financial aid or whatever, and you know what your bills are going to be. And then you also know that you have a lot of control. You have at least some control over how much you spend, right? So if you make a budget and you set some sort of goal, like maybe a first really simple goal for now might be, I want to put $50 in savings every month so that if something happens, my transmission in my car takes a dump, I have the money to pay for it. I don't have to put it on a credit card, okay? Just something simple. Let's use that as just an example of a budget, all right? But making a budget is how you're going to get on track, all right? So how do you get started? First, list your monthly revenues. All the money, list everything, all of the money that's coming into your account. For most of you, it may just be your paycheck, okay? So you know how much money you're going to make next month, most likely, or about. Put that in your budget as a first step. Then list your non-discretionary payments, meaning all that money, that the bills that you have to pay. What are some of those bills? Rent, car payment, groceries, car insurance, gas for your car, utilities, child support, whatever it is, right? Non-discretionary payments. Then list your discretionary payments. Look at and don't just guess, pull up your bank, go to your bank website and look at how you've spent every dime of your money every month for at least say 3 months, the last 3 months. Because if you were asked how much did you spend going out to eat? How much do you spend every month going out to eat? You would probably underguess by quite a bit. In fact, this is embarrassing, but I'm going to share it with you. One time when my wife and I were living, when we were living in Maryland, and I was working my last corporate job, I was making pretty good money. I mean, between the two of us, we were probably pulling down, I don't know, 260, 275K. All right. So we were doing pretty well, but you know what? Our spending was still out of control sometimes. We were so surprised that we weren't putting that much money back every month. And so we decided to get our budget under control. So we started making a budget. One of the first things that we did is we did this, we were following this step-by-step process. When we got to step 3 and we're looking back at how we spent our discretionary income, in other words, the money that we didn't have to spend, but we did. One of the things we looked at was going out to eat. Every month, we were spending over $1,000 just going out to eat. It's embarrassing now to think about that, but that's how much we were spending. I mean, you're living in the DC area, you know, money, sure, restaurants are, you know, we were living the highlight, right? We were making good money, but we were spending it like drunken sailors. And so we weren't putting that much money back. So don't just guess how much you're making, you're spending on different categories of things. Actually go in and figure it out. So some of these things would be, you can categorize these things any way you want, but like going out to eat is a big one. How much money you spend on on alcohol. That's not something that's necessary. We all like it. It's not necessary. How about satellite, you know, your cable and internet bill? You know, we probably don't have to spend as much as we do on that. Like even right now, we have an embarrassing amount of channels like, you know, Netflix and Prime and Hulu and Disney and on. We have several, right? You don't have to spend all those. What else as discretionary payments that we all, how about subscriptions to things? Like those add up, right? Those things that just cost $5 a month. Do we have to have all those? No, that's discretionary spending. You can cut out a lot of those things, right? Oh, by the way, you know what one I left off from up here? Credit card payments. All right. So once you've listed all the money coming in and the money that is going out, now determine categories of spending to include in your budget, and estimate the amount you would like to start spending on those things for each category every month, right? So that at the end of the month, you have money left over to do something with, that you can create wealth with, that you can put in a savings account for emergencies, all right? Then every month, track your actual spending and see how close you came to sticking to your budget. Did you do better than your budget? You saved even more money? Great. If you didn't, if you fell short, where did you fall short? Take steps to not let it happen again the next month, right? And here's another tip for you on budgets. If you have any debt, number 3 should go away until that debt is gone. That's painful, right? You kidding me? If I have $5,000 in credit card debt, you mean I shouldn't go out to eat or, you know, buy new clothes until that credit card debt bill is paid off? Yes, that is what I am saying. That's exactly what I'm saying. If you're in debt, your discretionary spending should go away or darn near go away until your debt's paid off. Yes, there's some pain involved, right? But like Dave Ramsey said, he's a famous financial advisor. He says, live like no one else so that you can live like no one else. My friends Albert and Michelle lived like no one else, as in crappy, for 6 years after they graduated college, so that today they could live like no one else. So they retired before all of their friends and are now spending their time traveling around Europe. Live like no one else so you can live like no one else. All right, I'll give you some more tips on how to do that. First of all, once you get a budget and you start sticking to it, you pay off your debt and start having more money to do something with other than spend it immediately, is start building yourself a safety net, right? So that's one of your uses for a savings account, and you can have more than one savings account. My wife and I have 2 savings accounts. One is called, we named it emergency fund. We have several months of our total monthly bills saved up, and it just stays in that account. We don't touch it unless something happens and we really, really need it. Then we would pull it out. Like, what if one of us lost our job? That would suck. Now, we might be able to still pay our bills with just one of our salaries, but it would suck. We'd probably start falling behind. Well, if we have several months, in fact, a lot of people say 6 months of expenses saved up in a savings account, are we going to stress and worry about money? No, because if something happens, we've got money in our emergency account to pay for it. All right. So that's what we're talking about. So start thinking in terms of, one way to build this is to have the attitude that you're going to pay yourself first. Like automatically at the beginning of the month, not at the end of the month, at the beginning of the month, right after you get paid, put a certain amount of money based on your budget, put that money into your savings account. Don't wait till the end of the month and then see if you have enough money to put in your savings account. No, do it as soon as you get paid. That way, the money that you have to spend during the month, when it's gone, it's gone. At some point, you may not be able to spend any more money until you get paid again. All right. Now, interest rate, you're not going to get much interest on money that you have in your savings account. So don't be thinking that you're going to grow that money with the interest that you're paid in the savings account. You're not. Do make sure it's FDIC insured. Most financial institutions these days are members of, have FDIC insurance. But I would, especially in uncertain times like now that we've apparently entered into the pandemic era, I would definitely want to make sure that wherever I had my bank or did my banking, that it was in fact for sure FDIC insured. Like I couldn't go under and I could lose my money. We used to laugh about that over the last few years, but hey, nothing like a pandemic to make you think about this stuff. All right, let's talk about credit for a little bit. We know what credit is, right? Your ability to buy something now and pay for it and take possession of it, but pay it off over time. All right. First of all, a little bit of advice. Don't finance anything but a car and a house. That's it. Don't finance furniture. My gosh, don't finance jewelry. Don't finance guns. I'm preaching to myself. Don't finance anything but a car and a house. That's it. And by the way, if you're not making a whole lot of money and you're not putting a whole lot aside, can't you cut down some of your non-discretionary expenses that we talked about, like a car payment? Hey, can we cut that down some? Right? Can you buy a used car instead of a new car to save money? Of course you can. Can you get a not quite as nice of an apartment so that you save money on rent? Of course you can. Can you get a roommate to split the cost of rent? Of course you can. You see where I'm going here? So think about the money that you spend. Use credit wisely. Again, if you have credit debt, other than a car payment or other than a house, your discretionary income or discretionary spending should go away until you pay it off. All right, so how do you get credit? Well, you gotta have decent credit. How do you know if you have decent credit? Check your credit score, right? So you can check your credit for free. If you do a search on free credit score, you'll find a million hits, by the way. It's a numerical indicator, essentially, of how credit worthy you are. It's made from, it was, the most common is the FICO score. That stands for Fair, Isaac and Company, by the way, just so you know. So your credit scores are based on your payment history. Are you paying on time? The total amount you owe in relationship to how much money you make, the type of credit that you're using, and then like if you've got a home loan or a car loan, hey, that's still showing that you're being pretty that's like considered pretty financially responsible. But if you've got a bunch of credit card, if the amount you owe is a bunch of credit card debt, that's a red flag. It's definitely going to lower your credit score. Right? And then the amount of time that you've held each of your credit accounts also goes in your favor, because it shows that, hey, you had that credit account for a long time and no one's canceled it. So hey, you must be fairly credit worthy. Make sense? All right. So the credit cards, yes, you can pay now or buy now and pay later. Yes, it's convenient. Yes, it's an easy way to track your expenses. It might give you travel miles or, you know, some kind of points that you can use for something. And yeah, that's super. Yes, I do recommend that you all have a credit card. One. Let me ask you this. Do you need a department store card?
No, because your MasterCard and Visa.
Exactly. You don't need to buy clothes on credit, first of all. So no. And do you know how much your annual percentage rate is on a department store credit card? Most of them are over 20%. That's insanity. Even if you were going to buy clothing on credit, using a department store credit card is idiotic. Why would you do that? Yeah, you get a 15% discount today if you fill out the application for this department store card. They're going to make it up, or they wouldn't do that. They're going to make it up by charging you over 20% interest. Plus, they know if you've got that sitting in your wallet or your purse that you're going to be likely to use it. Because it's so easy, right? I don't have to have the money. I got this piece of magic plastic.
I just figure if you don't have the money for it, you didn't need it.
Exactement, right? So if you've got those, I highly recommend you cut them up. Don't just cut them up though. Close the account. Like go to the website, log in, close the account, or call the number on the back of the card. Close the account. You don't need them. It's insanity. All right, but you do need one, and if you can't qualify for a credit card, a regular credit card, we'll talk about how to get you one. Here are the drawbacks. A lot of people just can't stay disciplined with a credit card. I mean, you need one, right? It's just, you gotta have one. You got to, right? Today, sometimes, you know, like say you're booking flights, you're buying anything online, you know, you might be able to debit your checking account, but you might need a credit card, right? You get a hotel room, a lot of them won't even accept cash. They want you to pay with a credit card because that way if you spend more, they want to be able to authorize and charge your card for damage you do to the room, right? There's a lot of reasons. A rental car is another thing. Most of them require that you have a credit card to rent a car for the same reason. So yes, you need a credit card, but do you need more than one? No. Now, some people will argue that, like, look, it can actually help bump up your credit score if you have a few credit accounts, like maybe a couple of department store cards and a gas card and a credit card, or 2 credit cards. Yeah, that might be true, but look at that number one drawback. Chances are, if you have it at some point, you're going to have a weak moment and you're going to use it. I recommend just get rid of them. All right. Keep one credit card. Also, gas cards. Why on earth do you need a gas card? Why would you? That doesn't make any sense. Buy gas on credit? What? No, it's stupid. All right. Know what interest rates you're paying on your unpaid card balances. Now understand that if you have a bad credit history, or you don't have much of a credit history, like you've never had credit before, yeah, you know what, you're gonna get cards. The only cards you're gonna qualify for are gonna have a higher interest rate. It's a given. It's a thing, right? You got to accept that. But you know what? You don't have to carry a balance. So let's say that you have a credit card with like a crazy high interest rate, like 20%. As long as you pay it off every time you use it, like you pay it off that month, that same month, then you don't have to pay the APR. that make sense? So don't carry a balance, but at least know what APR all of your cards have at the very least. All right, and there's fees, like don't pay a fee for a credit card. There's too many ones that don't have a fee. Why would you get one that has a fee? That's silly. Some charge like $75, and so you get issued the card with a $75 balance. And you're like, what the heck? I haven't used it yet. Well, that's the annual fee. And if you didn't read the fine print when you did the application, you might not have even known that there was going to be one. Know what you're signing. All right, of course, if you have late payments, if you go over, there's typically a grace period, but if you go over 30 days, you're considered late. Those late payments over 30 days ding your credit score. If you have it over 60, that's a separate ding, which is a bigger ding on your credit score, your credit history. And then if you have over 90 days, that's yet another category of lateness that further damages your credit history. And if you go 6 months, that's considered delinquent. That's when those collections agencies start calling and saying, hey, you need to pay, or we're gonna take your firstborn child, or whatever, right? And that definitely kills your credit. All right, so things to look for in the credit agreement. Know what the grace period is. Typically, you know, your credit card bills are due 30 days after you make get your statement, right? You've got 30 days to pay your credit card bill once you get it in the mail. But often they have like a 10-day grace period where they won't actually ding your credit for an over 30. So you actually have 40 days maybe to pay it. So know what the grace period is. A lot of cards, it's 10 days is the grace period. Know what your annual percentage rate is. Look at the example I found on the screen. By the way, I was in Cabela's one time, and they're really pushing the Cabela's store card, especially hard for a while. And I think it was during the Christmas holidays. And every time somebody asked me, hey, have you gotten signed up for a Cabela's card? And I was like, what's the interest rate? 26%. I'm like, 26%? Are you insane? I was always act surprised, even though I knew what it was. Know what the APR is. Like, for example, my wife and I now, I mean, we have perfect credit. We have a really, really high credit score. We pay the lowest that you can pay probably on a credit card. I think we pay 2 point something on the credit card. Actually, I take that back. I think we do have 2 credit cards, but we don't carry balance. And another thing is they keep upping. We had to actually call our bank and tell them to stop raising our credit limit. We weren't using it. We'd use it occasionally, but we'd pay it off. And so they kept raising our credit limit. Well, eventually that starts dinging your credit because they start looking at how much credit you have available to you. Like, you are just one drunken night away from accumulating debt you can't get out of, right? So we had to call them and say, hey, we don't need to buy a car with our credit card. Stop raising our limit. Let's set it at this amount and let's leave it there. So know what your APR is, know what late fees there are when you make late payments, and any other fees. So it used to be that credit card companies did a lot of predatory lending. In fact, they would be on college campuses during registration like crazy. They'd set up booths and they have free t-shirts, if you sign up. You're like, hey, do you have a credit card? Would you like to have a credit card? How would you like to have a credit card? Well, it'll just take 5 minutes to fill out this short application, and right away, we'll give you a free t-shirt just for signing up. And these college students had no idea what they were signing. And they were signing up for credit cards with like a 25% interest rate that had like $100 annual fee. and had ridiculously high late fees and stuff like that. So, hey, government had to step in at some point and like, hey, all right, enough's enough. So they did. These are some of the basic things that came out of that. Got to get 45-day notice before you make any changes to an agreement. You can't raise interest rates on existing balances, except for balances that you may be more than 60 days late on. This one was controversial, but I see why they did it. It's because of that example I gave you. It says like, yes, I know you're old enough to go off to war at 17 or 18, but apparently as a whole, you're not mature enough to make responsible choices when it comes to credit. So you gotta be 21. If not, you at least gotta have a pretty good income, a decent amount of income, or a cosigner. It also put some limits on some of the crazy fees that they were charging. So Dodd-Frank added some more provisions in 2010. It created this, this was fairly controversial too. I think it turned out to be a ginormous waste of money, but they created yet another government agency, this one called the CFPB. I guess one thing, positive thing that came out of it is that they're trying to make sure that we speak plain English in our credit card agreements, for example, so that people can understand what they're signing. It just took away some of the deceptive wording of a lot of loan types. All right, they also have to give you a free credit report if you get rejected for something. Again, you can get it for free anyway. All right, so put down the card or cut them up. Rule number one, if you have a credit card balance, your discretionary income, no mas until that's paid off, or very, 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 very little, right? Allow yourself to go out to eat twice a month to an inexpensive place, maybe, but pay off your credit card debt before you start spending discretionary income. It's much better way to go. You're actually saving yourself money in the not very long run by doing that. You're also giving yourself breathing room. If you absolutely lack discipline, the book says use a debit card. I would tell you that that's not necessarily better if you have a lack of discipline when it comes to credit, because sometimes if you're not using cash and watching that cash leave your wallet, you tend to forget how much money you're actually spending, right? Don't you forget sometimes, like, holy crap, how can my account be so low? Oh, well, I bought all this stuff on my debit card and I wasn't really tracking how much I was spending, all right? Something that some people actually do is go to the cash system, by the way, and I'll just throw that out really quickly. You literally, when you make your budget and you figure out how much spending money that you would like to stick to, you know, how much discretionary spending you're going to do, and then give yourself that amount, take that out in cash at the beginning of the month and put it in your wallet or your purse. And you can watch that money disappear as you spend it. And when it's gone, it's gone. My wife and I did that for several years when we first got married, and it really helped us curtail our spending, because, you know, you'd be ready to buy something and then you'd be like, oh, wait a minute, I only have this much money left. Probably going to want to go out to eat with my friends on Friday. Okay, I'm not going to buy that. Right? So the cash system, hey, whatever works for you. Again, I would get one credit card, cut up the other ones, and close the accounts. My advice. All right, so we're not going to go back through these because we already went through the first three. Actually, the first three. So let's talk about some of these other ones. All right. So choosing a broker, we've already covered that, right? Full service broker versus discount broker versus a robo-advisor. Yeah, do your research and make sure that that brokerage firm or website gets good reviews. If it doesn't, pick another one. All right. Now, building a portfolio. Remember, building a portfolio, all we're talking about is a collection of all of your investments. Now, for most of us, stocks are not going to be part of that, like individual stock investing. Hey, that's fine to play around with your discretionary income after you've got a savings built up and you're out of credit card debt and you want to spend some of your discretionary income on buying individual stocks. That's fine, but for most of us, that's probably not the way to invest. All right. But if you're doing your own investing, yes, you'd want to have a diversified financial portfolio because it reduces risk, right? Remember though that there's a trade-off between risk and return. The investments that can make you the most money, like individual stocks, are also the riskiest. Like you can lose all that money that you're investing or a whole lot of it. But what I would do is educate yourself. You guys are doing that right now. You're investing in yourself, right? By going to school. By going to school, getting a degree, you can get a better job, make more money. So I know it sucks being poor, going to school, while your friends are out, spending all of their minimum wage paycheck on things. Oh, at least I'm speaking about myself. How I thought about money at that age. Instead of spending all your money, you're spending a lot of it on your education. Instead of spending all your free time playing video games, you have to study and write papers. That's an investment that you're making in your future. Good on you. Health and fitness. People that are physically fit, did you know that they not only look better, they feel better, and they can concentrate better and tend to get promoted faster. So be physically fit. As best you can. And we all have, physical issues and whatnot, but try to be as healthy as you can. Eat healthy, try to exercise. If my wife was listening right now, she'd be like, "You're preaching to the choir, mister. You need to practice what you preach." I do okay with those things, but not great. Make yourself marketable, right? If you guys can get internships in the type of business that you want to work in or the type of industry you want to work in, do so. Do volunteer work if you have to get some experience in it. But like, if you can work your college job in the same industry that you want to work in, that will help you get your whiz-bang job in that industry when you graduate. Okay, so something to consider. And you can't always, like I delivered pizza. I didn't want to be in the pizza business when I graduated. I did all kinds of crappy jobs in college. All right, let's talk about planning for retirement. Long-term growing wealth. All right, some ways to do that. Individual retirement accounts. Bank salary. You can go to your local bank and say, I want to invest in, I want to open up an IRA. An individual retirement account. So what that means is you're able to invest your money and reduce a couple of different ways. You can get a traditional IRA or a Roth, but essentially it works like this. Every month, you can have it set up to where it will, if you have your, say you have your account with Bank of America, right? You can go into Bank of America and say, I want to open up an IRA, and they will say, okay, great, have a seat. Are you interested in a traditional IRA or a Roth IRA? And whichever one you choose, you're going to give them money every month, and they're going to invest it in this IRA. And there's all kinds of different types, IRAs that invest in all kinds of funds, but they'll ask you a bunch of questions, help you figure out which particular IRA to invest in. But there's two broad types, all right? A traditional one reduces your, just like it says, it reduces your taxable income in this year, the year that you buy it, right? Because you can, you can like invest like up to $6,500 for an individual. And I need to get updated on the latest numbers, but it's like $6,500 is the maximum amount that you as an individual can invest in an IRA per year. But if you get a traditional one, it actually reduces your taxable income for the year. And your earnings are tax deferred, meaning you're gonna pay tax. Like you're not gonna pay tax on that $6,500 this year. But as your money grows over the years and you get to retirement and you start taking this money out and spending it, you're gonna get taxed on it. Huh. So that kind of sucks. Like you don't know exactly how much money you're going to have when you retire because some of it's going to go to taxes. And by the way, you're not going to know what the tax rates are going to be by the time you retire. I wish there was another alternative. There is. It's called a Roth. The Roth IRA does not, let's say it's $6,500 that you can put in, that you put in this year into a Roth. Well, if it's a Roth IRA, it does not reduce your taxable income. In other words, you pay taxes on it, but all of the money that grows over the course of the time that you leave it in there, hopefully for several decades until you retire, when you pull it out, it's all yours. You've already paid the tax on it. You paid the tax on it as you were making it. But the money that grew is tax deductible. Like it's tax exempt, like you don't have to pay taxes on it. So all the money that grows in that nest egg is yours. I think the Roth is the coolest thing ever. All right, so that's one way you can become a millionaire, right? That's like $6,500 a year. How could that grow into $1 million or whatever? Well, the compounding magic of money. As it grows, you're making interest on a larger amount of money. As it grows, you're making interest on a larger amount of money. As it, see what I'm going? Every year, it's piling, it's growing exponentially. If you do Roth IRAs every year for 30 years, you're gonna have a ton of money. All right. So another thing you can do, and you must do, or I will find you and throw an eraser at you, is participate in your employer retirement plan, your employer's retirement plan. Now, most companies, most private sector businesses of any size offer 401ks. But if it is certain times of nonprofits, it might be called a 403b or even a 457 if you work for the government. But they're all essentially the same. Here's how they work. You fill out some paperwork and you can elect to have a certain percentage of your income taken out of every paycheck. It's automatic every month. You don't miss it because once it starts coming out, you get used to living on a lower amount of money, right? So you can elect to say have 6% of your income, your paycheck, put into this retirement account. And then they'll give you a list of mutual funds that you can elect to have that money invested in. And usually they're in risk categories. So when you're really young, you probably want to have like maybe 10% in the really low risk funds and maybe 40% in the middle, or even less than that, maybe 30% in the middle, and then the rest of it, 60% of it in the highest risk category, because you've got time to ride out market fluctuations. But if you're like my age, then your percentages are going to be different, right? I'm going to have maybe 20% in the really safe and maybe 60% in the middle of the road investment mutual funds, and then the rest of it in the riskiest, right? A very small amount in the riskiest. And then as I get ready to actually retire, I'm gonna move everything into the lowest risk type fund, right? Because I don't have any time to ride out market fluctuations. Then I'd probably move it out of 401k into some sort of income fund that's based on some kind of annuity, like or maybe a mutual fund that invests in bonds or preferred stock. All right, so I'm not going to go through these, but spend a lot of time on these. But obviously, the cool thing about these employer plans is they automatically take out of your check. You won't miss it, right? You'll just get used to living on a little bit less income. You'll forget that you're even doing it until you get that email once a year saying, "Hey, it's time to take a look at your account, see how much money you built up, and make any changes, that you want to make to the types of funds that you picked out of our list of available funds." You can pull out some employer plans. You can take out quite a bit of money. Sometimes a company will say, "Hey, for the first 3% of the money that you put into your retirement account, we will match dollar for dollar." Holy crap, that's awesome. You have to at least put in the amount up to the matching amount where you're just giving away money. There are no disadvantages. The book points out some, but that's ridiculous. There's no downside at all. Yes, not all companies have them. Is that a downside of an employer plan? That not everybody has one? That's stupid. That's like saying that the bad thing about Corvettes is not everybody has one. That's stupid. The book is stupid in some ways. Same with it might require a vesting period. That just means that you might have to stay with the company for like 5 years before you get to keep any of the interest that you're making. In other words, if you quit after 4 years, then that could mean, depending on how long the vesting period is, let's say that this 5-year vesting period, you quit after 4 years, you would get back all of the money that you put into it, but you wouldn't get any of the interest that it accumulated. Why do companies sometimes do a vesting period? It's to keep you. They want to keep you around for a little bit longer because it's expensive to find a new person and train them up. All right, that's it. That's all I got. I know that was a whole lot at one time. So take some time, read through all that information and think about it, study. And as always, if you have any questions, just call me. I have my office phone forwarded to my cell phone. You can also help each other on the discussion boards and Brightspace. So that's all I got for you. Have a good rest of your night, and I will see you next week.
All right.
Take care.
You too.